I am the tax advisory partner in Hassans, and I'm the chairman of the Gibraltar Association of Tax Advisors. And I'm going to give a talk today about the increasing importance of transfer pricing. Transfer pricing is kind of thing that it's puts everybody on, but it's very, very important. So, what's our current tax compliance landscape in Gibraltar, and how does that feed into tax compliance? Well, the Minister with responsibility for taxation has made his attitude very clear. He wants, in this quote from a speech he made to Parliament, I want to reiterate the importance of this step. This insert, that was the introduction of taxation on interest for insurance companies and DLT. It is essential to ensure that large corporations contribute their fair share of corporate taxation. So that's his attitude. Everybody knows that every country in the world has spent a lot of money during COVID. I don't see why Gibraltar would be any different. So there's obviously fiscal constraints on the government, and they are out to ensure that compliance is rigorous. In April, Minister Peter made a series of points. One of the first of which is that the financial sectors, and I think we assume that he means by that gaming and financial services, have tax losses in Gibraltar in excess of 2.1 billion. Some of them are just not paying any tax. They continue to roll that forward. So they report, and a lot of them are reporting smaller profits in comparison to the higher profitability group level. Though that may be fact specific, but that's the point that he raised. And he said that in cross-border situations, Gibraltar is competing for tax revenues with other jurisdictions. The pressure from foreign tax authorities to receive a higher proportion of corporate tax revenues currently attributed to. I think that's the key to the transfer pricing piece. He is aware that other people are after his tax base, and he wants to make sure that it's protected and the tax authorities are. So what else has happened? I mean, there are some other indicators out there. The often announced recruitment of two chartered tax advisors from the private sector to the tax office, which I think they finally picking up their posts in the last week or so, something in the Chronicle. Ex-member of GATA, highly competent individuals who will upskill the tax office. He's introduced legislation to equalise treatment of interest receipts by insurance companies and DLT firms with that banks, and there have been new appointments to the tax tribunal. So that forum appears to be ready for revival. It feels like the tax authorities are tooling up, to use a better, to using another inelegant phrase. So if that's the case, then we an increased emphasis on transfer pricing. That's why we've taken the time to talk. Now, what is transfer pricing? Transfer pricing is the process by which the arm's length price of goods or services sold between related entities is arrived. Well, why is that important? That is important because of a thing called the arm's length principle, which features in the UK Gibraltar Civil Tax Treaty. And that says where conditions are made or imposed between two associated enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profits which would, but for those conditions, be accrued on the enterprise, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. But what that means in human language is that if you artificially shift profit to the lower tax jurisdiction where you have two jurisdictions, or you artificially shift profit in order to gain a tax benefit if it's domestic, then the tax authority may disregard that and tax what it believes is the correct amount in the correct places. And the defence against that is to price those relations as if independent parties had entered into. So, TP is how you price that. It's not just the price, it's also the terms and conditions. You need to look at the terms and conditions because the terms and conditions dictate the price. You should not just say, oh, there's a loan, it's £100,000. NatWest will give me a mortgage for £100,000 for X, when the conditions of the actual loan pricing deviate substantially from that which NatWest would give you. So it's important to remember this is not just about price, it's about terms and conditions. So other than the treaty, is transfer pricing in our law? Yes, it is. It's been there. Parts of it have been there since 2010, and a little bit was added in a few years ago, but it's never been particularly actively used, but it is there. So in Schedule 4, Chapter 2, Paragraph 4, so Paragraph 1, transactions with connected persons, we have this, where a person carries on business with a connected person, and it appears to the Commissioner, of course, of business between those persons is so arranged that the business done by the person charged for taxation in pursuance of this connection with the other person produces the person to the person either no profits less than the ordinary profits, losses or increases the losses which might be expected to arise from that business. The person shall be assessable and chargeable to tax in respect of the profits which might be expected to arise from the business if it were transacted in accordance with the schedule. And what that means, that is essentially the arm's length principle. That subparagraph is the Gibraltar articulation of the arm's length principle. And the Commissioner has the power, where there is a tax benefit, to adjust the transaction, the purposes of tax, to what the arm's length principle would give you, and what transfer price would give you. We have another expression of the TP in section 40 bracket 1, which is what's called the general anti-abuse rule, and that's a little more complex. Where the Commissioner believes that a person who is or would otherwise be charged for tax in accordance with tax has entered into an agreement arrangement which eliminates, reduces, or would eliminate or reduce the amount of taxation payable. That arrangement is artificial, fictitious, or has elements which are artificial or fictitious. He may disregard the arrangement or parts of it to eliminate, reduce the taxation payable, and assess the person the amount of the taxation due to the arrangement, or those parts of the arrangement which regards, and that section must be construed in accordance with the TP guidelines. It's more than slightly odd drafting around entry into laws and act. You read that literally, you should look at the 1997 guidelines, but we looked at 2017. So it's there. Section 40 is more complex because it needs to have this element of artificial or fictitious, and it is not strictly between connected persons, though if you're acting in concert, you would probably meet the criteria for connected persons. And it has to be it's a negative power. So section 40 does not give the Commissioner power to read the correct pricing in. It just says that he has the power to disregard, and so that would lead to some slightly odd outcomes. That I would expect him to use transaction with the person's power much more frequently because it's much more aligned to the to the OECD market. So what does any of this mean? So this means that wherever an enterprise deals with a connected enterprise, and the definition of connection is in Schedule 4, things like subsidiaries, shared control, things like that. And the outcomes of those dealings have an effect for tax purposes, then those dealings must be thought about, considered, and priced as if the parties were not connected. Groups need to monitor intra-group transactions. All services and goods supplied by one to another in the same group must be charged for with a profit. I hear this all the time. Oh, it's just a recharge. We just recharge it. It's just the staff. We just recharge it. Well, if that just recharge gives an outcome, which means that less Gibraltar tax is being paid, then it has to be TP'd. What happens all the time, I see it all the time. Is anybody else having problems with the audio?
No, it's fine for me, Graham.
Okay, sorry, we just had a message. Okay. All right. So anyway, so what happens all the time, and this happens particularly between jurisdictions which are, we'll say, low tax jurisdictions. So, as an example, GIB will have some employees, and the services of those employees will be utilised by an entity in Malta, right? And it'll just be a recharge. We'll just do a recharge. No, those services, by just doing a recharge, pound for pound, those services are being sold to the Maltese entity in our example, or it could be Luxembourg, or it could be Jersey, or it could be Guernsey, yeah, or wherever. They're being sold to the Maltese entity in our example for a price less than they would be sold for if it was independent entities. And the Gibraltar entity is denying itself profit, and that profit should accrue tax, and tax should be paid if we're going to follow the arm's length principle. So I think that kind of, oh, just do it, is going to be where they're targeting. It's low-hanging fruit in the tax office. Yeah. Now, when we get to the end, you'll see that I'm not proposing that everybody does a transfer pricing system, right, for everything, and spend tens of thousands of pounds on tiny little recharges. But I do think it's important that some exercise has gone through and something that's reasonable arrived. Yeah. So tax must be paid on the intra-group profit if it's within the Gibraltar tax base. Now, it's generally less important if you've got two GIB taxpayers, right? Because you're shifting profit from one person paying Gibraltar tax at 12.5% to another person paying tax at 12%. And it may end up with no result. But if there is a tax effect, it should be considered. And that also, if there's a tax effect in the favour of the taxpayer, you could have a situation where one entity has what could be referred to as stranded losses, and it's recharging pound for pound and ends up with no profit to set its losses up against. It can work in the favour of the taxpayer as well, and but the rule is the same. It still should be undertaken. Otherwise, you end up breaching the art of principle, let alone you losing your stranded losses. So I think that's important. So how do we work out the amount that should be charged? Because nobody wants to spend £50,000 on a full transfer price for the if you can help it, but we'll go through the basic principles and then we'll arrive at something that would at least be a step forward, right? So the first thing you need to do when you look at the pricing the services or the goods is what's called a functional analysis. It's the starting point. I mean, functional analysis is a fancy way of saying what is being sold. You need to identify what is being sold before you can price it. So what are the services and goods? What are the risks and assets required to deliver the services and goods? What functions need to perform? What are the terms of the contract? Are they standard? Do you need to modify your pricing because the terms of the contract are particularly odd, that kind of thing. So you need to do an analysis to work that out, right? Then, if you were going to do the full transfer pricing model, you would apply one of the 5 approved methods. These are the only methods that are approved, apart from in certain cases as a safe harbor. But these are the 5 full model methods. That's comparable uncontrolled price method, which is simply going out and finding out what other people charge for this. That's the most accurate. Yeah. And there's a resale price method, which looks at compares the unconnected parties gross margin, but you start at the price that's being charged, and then you work out what the margin is within the price. Cost plus is very similar, but the other way around. You start off with the cost, and then you add a margin. Yeah, these are all based on comparables. You need to look at comparables. Then the profit. Then you've got the 2 non-traditional methods, which is the profit split method. And that is what share of the profit should a party get based on their contributions to the combined operating profit over the piece. That's very good for JV profit shares and things like that. Then we have the transactional net margin method, which is net profit relevant to relative to a relevant base, and that's things like the relevant base. You can pick anything, as long as it's relevant, right? So the number of employees deployed, the assets that are included, the sale. It's very similar to cost plus, but it takes a broader base rather than just cost. Broader comparable. So I'm not going to go into great detail about those 5 methods because they are very detailed. There are lots of resources available, but you need to understand there are a number of methods available. The most popular one that I see is cost plus, especially when it's things like loans, whatever. So they do have each of the methods do have their own strengths and are better in certain circumstances. And the TP guidelines, these examples that I give are lifted from the TP guidelines. So resale price method's good for marketing. Cost plus is good for manufacturing, intermediate services, low value add services. Profit split's good for JV shares. Transactional net margin method is essentially, I think, what you use when you don't know which one to use. So that's worth learning about in more detail, and I'll give you some resources. But it's important to know there are 5 different methods and you can't use anything else. So how rigorous should we be? Like I said at the start, it's unlikely that for your £100,000 contract, you're going to go spend £30,000 on a gold standard transfer pricing study from Deloitte in Luxembourg. But we should bear some things in mind, right? So our tax office is reasonable. It's always been reasonable. Yes, it's going to be, they're taking a more aggressive stance, probably. But they've always been reasonable, and they're not like a business destruction department. They've always been helpful and open. But that doesn't mean to say that we shouldn't take this seriously. So the higher the value of the TP, the transfer price goods or services, then obviously the more effort you should apply. If it's a 15 billion business sale between 2 related parties, then of course we should look harder at it than if it's a single employee being recharged out. But when you consider that there is an issue, you should approach matters carefully and record your thinking. This is very important. Write it down while it's happening, because when they come back with a query in 18 months' time, you might not remember what your thinking is, and your thinking is what will make it reasonable, right? So you could go out and get quotes for similar services. I did a piece not long ago where I went out, looked at websites, looked at pricing on websites, made some phone calls, got alternative, got prices as if it was being done, or at least a steer, an indication, and then used them as references for my work. So that kind of thing is a reasonable approach. If you sell this service internally if the company sells this service to independent enterprises or non-associated enterprises anyway, then look at the pricing there. The pricing inside the group should match the price that you would sell the service outside the group for. There's lots of resources that you can use to make your starting point reasonable. Where you've got high value, then it's probable that you should get a profit transfer license, and they are expensive, but they are gold standard, and they will do a good job. A lot of the people that provide transfer pricing studies in Gibraltar will actually refer it to a specialist team in the UK. I don't know of anybody that's full TP studies in GNEP, do you?
No, I don't. They always are provided by UK.
Yeah. So that's important, but you will be able to get a steer from those practitioners if you're not looking to go the full 9 months. And importantly, keep good records. Always keep good records. Like I said, the records will be the thing that are your defence if there's ever any challenge. So, is there a safe harbour? That is there a sort of standard approach that you can take? I'm not going to talk about the unilateral safe harbour in the Income Tax Act, because I think it's something which is old-fashioned and the tax office are not keen on. They should consider it. The OECD have a safe harbour approach, which is not formally adopted here, which is simplified for low value adding intragroup services. That is, whilst it's not formally adopted here, I know the Commissioner will be influenced by it, right? So if the services that we're talking about are of a supportive nature, they're not part of the core business, they're contributive to the, that's a typo, sorry, economically significant activities of the group, they use no unique or valuable intangibles and do not involve the assumption of significant risk, then there is a catch-all 5% markup, gross margin. Yeah. So you can just put 5% in. If you tick those 5 boxes, you're good for 5%. But you're not good for 0. You're never good for 0, right? So they do give us helpful lists of things that probably would be included and things that would be definitely excluded. Included are accounting and auditing, human resources, regulatory, IT, legal, admin, and clerical, but only where they meet the above tests. So if the business of the company is accounting, the group is accounting, and you're doing accounting in German transfer pricing it out, it wouldn't fall in here. It's where it's a supporting aid. And excluded would be research and development, manufacturing, sales, marketing and distribution, corporate senior management, financial transactions, exploration and extraction. So that's helpful. I would be careful on regulatory, so compliance, because compliance does involve that's client compliance, like due diligence and all that, where that does take on significant risk because of risk. So I would not include that in the safe harbour. So how much weight does this have in GIB? Safe harbour is not part of our law, but it is an attempt to estimate an acceptable margin. It's not detached from reality. 5% has been picked for a reason by the OECD, and it is a very common margin for such low value added services when you look at looking around. So I think that the Commissioner may well take, and he's he's sort of indicating to me they're not in anything that I can rely. We may well take the low value add services guidance as a guide on what would or would not be acceptable. What does this not mean? It does not mean you don't have to be rigorous. And it does not mean it's not complicated. It doesn't need to be done properly. So it doesn't let you off the hook altogether, but in certain circumstances, it will help you and will be a good estimate where the services are not sufficient to justify the expense of a full TP study. So what are things that I see regularly, and I think tax advisors in the room would probably agree, that are not TP proper. Interest-free loans across borders when made between enterprises in the same group. If a Gibraltar company lends money to a sister at zero, registered in another country, at 0% repayable on demand, and the interest would add up to more than £100,000, then you're in breach of the transaction with the next person of yours, and it should be transferred by spot. Sharing staff and not billing, management fees, general recharge of expenses with no markup because the accounts team can't be bothered, agency activities. The underlying principle is any exclusion of a markup which shifts profits out of Gibraltar by charging less to the recipient than would be charged with an independent recipient is a breach of the rules. And I expect the tax office, because it's so simple to do, to be hoovering these things up, right? So it should be the case that these things are done. So what are the next steps? First of all, do something. Identify your intra-group transactions. Identify if they result in less tax being paid in Gibraltar than would be if the arm's length principle was applied. If that is the case, then add a margin. Calculate the TP price based on terms and conditions of the functional analysis. And by calculate it, I mean go out and do the exercise yourself. Go onto NatWest's website and look what an unsecured loan is available for on their loan calculator. Do that kind of thing. Print things off, put things in the file. Keep records. It's not a particularly difficult task to undertake. And once you've done it once, as long as you refresh it regularly, you don't need to keep doing it. If you're a TCSB, you can price this once and then roll it out across other entities, and get full studies done where appropriate. Take advice. There are many strong chartered tax advisors in GIB, hopefully all of which are members of GATA. We are more than happy to give advice around this, to get you comfortable that you're doing it properly, that you're not exposed, and that would be a good step forward. Again, in the conversations with the tax office, it will be, have you behaved reasonably? Have you taken this seriously? That kind of thing is going to be important when they're looking at the files. So learn more, right? These slides will be circulated to everybody who said that they're going to attend. Learn more. TP guidelines are lengthy and complex, and sometimes written in gibberish. They are available online, just so you know. This is how long they are, and then there's other ancillary pieces. If you want more detail about the various pricing methodologies, there's an episode of my podcast, which there's a link there too on Apple. But if you just Google International Tax Bites Transfer Pricing, I'm sure you'll find it. Or get a qualification. GATA would love more people to have Chartered Institute of Taxation qualifications in GIB. There is a TP module, transfer pricing module in the audit, which is the gold standard international tax qualification globally. So we would very much encourage people to take a qualification where they can. And that's the end of it. I managed to do it in 30 minutes. Whole of transfer pricing in 30 minutes. Are there any questions?
I haven't got any questions, Graham, but I just wanted to say I think that was really helpful because from my perspective, I think transfer pricing is something that isn't discussed very much in Gibraltar, and it should be discussed more, and it certainly should be discussed in human language. And I think it's something that today we just haven't seen or heard of very much. So I think it's really been a useful presentation.
Okay, thank you, Linda. That's very kind. Does anybody have any questions or wants to say nice things or horrible things? No? Have the tax office raised any questions in this respect? I have seen some questions yet. We're starting to see queries coming back.
And now they've got more expertise. I think there'll be more queries on TP.
I think if I'm correct, one of the recruits has TP expertise, right?
Yes.
Yeah. So I would expect him to focus on that because it is, like Lynette said, it's not discussed, it's not done, and therefore it's low-hanging fruit. They could just send a letter to everybody, every company in the country, and say, do you make any interest-free loans cross-border? And that would be a start. No, they won't, because it would be they wouldn't have the capacity to deal with all this paper. But that sort of thing would be easy for them to raise money with. So I just think to ignore it would be an error, given it's not actually that hard to put things right. So has anybody else got any other questions? In which case, you want to have a coffee because you've got 25 minutes of your life back. Thank you very much. Thank you very much for attending.